This week, I'm going to make 3 points about U.S. financial markets. Last week, and 2 weeks before that, I pointed out that it's very hard to sell a stock while the company is in the midst of reporting excellent earnings. My first point is that U.S. stocks have been very resilient to bad news for the last several weeks because U.S. earnings reports have been so very, very strong. How strong have they been? Well, S&P 500 earnings, according to FactSet, year on year for the fourth quarter grew by 16.4%. That's way higher than what they do on average. So it's a strong number in an absolute sense, but it's also much better than the market expected. Analyst estimates for S&P 500 earnings growth at the beginning of the year was only 11.8%. So the earnings are coming in much better than expected. And so when we had bad news over the last several weeks, like at the beginning of the month, we had the news about DeepSeek, which made people question how much infrastructure spending that was going to go into data centers in the US. We had Trump announcing surprise tariffs against Canada and Mexico. During all that, US stocks held up pretty well. And even this week, the S&P is up 0.7% from the last time I spoke to you. And during that period of time, Trump has announced steel tariffs and aluminum tariffs, and he's also threatening to announce reciprocal tariffs against many, many different countries. So in the face of all that news, which should cause a little bit of consternation for equity investors, stocks have moved higher, and that's basically because of all the good news that we're getting from earnings. Now, my second point that I wanted to make is so far this year, things are happening pretty much according to what Wall Street strategists expected. That's not the usual thing to happen. I mean, very often they get it wrong. They probably get it wrong more often than not. But anyhow, this year, they seem to be on target so far. The first thing, they were expecting US stocks to do well. And the S&P 500 is up about 3.4% year to date. So that's a pretty good performance. The second thing is they said, unlike last year, when some very big tech stocks really were driving the market higher, this year, the returns are much more broad-based. So last year, if you look at the Mag 7 stocks, on average, those stocks were up about 60% in 2024 that were really driving the market. This year, they're flat, yet the market is up. That's because the other stocks are driving the returns. Now, why did the strategists say that? Well, last year, it wasn't crazy that the Mag 7s outperformed so much because nearly all the earnings growth in the S&P 500 came from big tech stocks or tech-related stocks. This year, the analysts are expecting earnings to be much more balanced, with the other companies that aren't the really big tech stocks also reporting strong earnings growth. So it was kind of logical for them to expect the returns to broaden out, and that's what's happened. And I'll just pause here and I'll give you a little example of what I'm talking about. For fourth quarter earnings, the sector that's reporting the strongest earnings has been the financial sector. Year-on-year earnings growth for the financial sector is about 53%. So I don't have to say that's extremely good. The comparable the year before, earnings weren't so good, so they had that going for it. But it was also a huge beat on what people were expecting. the analysts were only saying that the year-on-year earnings growth for the financial stocks would be in the high 30% type growth. So everything's about that's positive. And of course, financial stocks have been outperformers. And part of the reason I used financial stocks as my example there is because that has been one of the sectors, as when we're talking to our clients here and said, maybe you should diversify away from the Mag 7, that's really one of the sectors they've been most receptive to also buying. So once again, it just shows our clients are pretty darn good because they've been willing to buy those bank stocks for a pretty long period of time, and they're sort of gaining the rewards from it because, like, the S&P financial sector is up more than 7%, and so it is beating the overall market, and of course it is beating the Mag 7 stocks. The third point I want to make is about something about what the market's going to need to continue to go up going forward. And basically, I'm going to make 2 points here. The first thing is wants clarity on Trump's tariffs. What the market would like to do after Trump threatens tariffs here and threatens tariffs here is to quickly to settle down. And what it would be happy with or would settle for is just a broad tariffs against most goods coming into the United States. Then companies could plan for it, the currency would adjust for it, and business would go on. Additionally, it would help as a revenue stream for the U.S. to reduce its federal budget deficit, which is something that the market is at least worried about a little bit because it's something that's probably keeping Treasury yields higher than they would otherwise be. The second positive thing the market wants, and is a little bit related to the first thing, it wants to see interest rates drop. Currently, the Fed is on pause. Jay Powell was just speaking before Congress yesterday, and he said, we're not in a hurry to cut rates anymore. So no one's expecting a rate cut at the next meeting in March. But as we get further into the year, Wall Street traders, Wall Street bulls, I should say, would like to see the Fed resume its interest rate cuts. And in order to get that, you're going to have to see inflation come down. Now, there's two ways inflation will come down. One is that the U.S. economy stops growing strongly, and the market won't like that. But the other is it just comes down on its own. So the market wants to see U.S. economic growth to continue at a strong pace, maybe not as strong as it's doing right this second, but continue to be solid, and it wants inflation to drop. So U.S. economic data remains very positive. There's not much worry going on about that, but of course we never know what might happen later on in the year. Inflation, we have a key piece of data coming out later today. It's Wednesday afternoon here in Singapore, Wednesday night, Wednesday morning in the U.S. CPI data will come out. Those numbers are expected to show very little progress towards inflation coming down. So I'm basically saying if you take it at face value, hey, we're not going to have good news. But markets don't work like that. If for example, core CPI is expected to go up 0.3% month on month, we'll be printing January's figure tonight, and it comes out 0.2%, even though 0.2% is still kind of a high rate of inflation, it's better than expected. The markets will react positively. You'll see interest rates go down. I'm going to finish up with a little bit of tangent to talk about gold because it's been on such a tear lately. If you see interest rates drop, the dollar will weaken, and ordinarily that would mean the gold price will go up. My sense right now is that we've had such a big surge that if we do have positive news and you don't have an immediate positive reaction to the gold market, in the gold price, you're going to have profit taking seek in, and you'll see some correction in the gold price. So if you're a gold bug, take a good look at the market tonight. If you have that good CPI number, which is good for the gold, and you have the dollar weakening, and it's good for gold, and the gold price drops, that might be the buying opportunity that you're looking for.